Sometimes risk is not the enemy. It's the only real way forward. Or when was the last time you did something that scared you to death, but you knew you had to do it anyway? Many people come into trading looking to change their lives. I did too. But it wasn't the money that changed me. It was the risk. It was investing the only $500 I had, selling things from my house, knowing nothing about trading, but with the certainty that I wasn't going to give up. Today, after more than 7 years of experience, providing well-being for my family and training thousands of students all around the world who now collectively have withdrawn over $10 million, I learned something more important than any other strategy out there. Risk is not avoided. It's understood, it's managed, and above all, it's trained. This course is not made for you to copy. It's made for you to think, to learn, to read the market like a language, and above all, to learn to read yourself when you're about to take a trade. If you're willing to unlearn in order to learn from scratch, if you're willing to take the risk with awareness, with structure, then you're exactly where you need to be. And no, you're not alone in this. There are many of us who have decided to stop surviving and start trading with intention. Are you ready? Before you begin, ask yourself, do you want to trade seriously or you just want to get lucky? Most people want to jump straight to the point, entries, exits, strategies, scanners, this and that, but that's like wanting to run before learning how to walk. And in the market, that can cost you a lot. In this module, we're going back to basics. You understand how the market moves, what to look, what to use, how the broker works, and most importantly, how you need to think from day one. Because yes, this is mental. And if you don't train your mind from the start, later on, you end up sabotaging yourself. So take this module seriously. Don't see it as just an introduction. It's the foundation for everything you build afterward. Focus on it, repeat it if necessary, and take notes. This isn't just any class. You're investing in yourself. See you in the next first video of the basic module. Many people get into trading without having any idea what they're doing, and then they wonder why they lose money. What they don't realize is that Forex isn't just a name that sounds professional. It's the market where the world's money flows. In this chapter, I'm going to explain what Forex is and how it works so that you can stop just looking at charts and start understanding the system behind them. You'll also learn how the supply and demand works, but explain without any jargon, so you can actually see it reflected in real price action. And something crucial, I'm going to talk to you about the global market sessions. When the world stock exchanges open, why those times matter, what happens when they overlap, and during which moments there's most volume and the most manipulation. If you understand this, you'll stop trading blindly and you start seeing the market with logic. Let's go straight to the point. So right now I'm going to show you the tools, but I'm also going to explain you how demand and supply works. And I'm going to do it as simple as possible. As you can see over here on the screen, I'm going to use apples. And I'm pretty sure this concept, you've heard it before in school, you've heard it before from your parents, or maybe just life has taught you this principle. But little did you know that this same thing applies into trading today. So let's talk about supply and demand. If you are selling apples, or you want to buy apples, you're participating into trading. You're participating into the supply and demand. So let's say you want to buy apples. That is a demand. You wanted to buy something, it's a demand, okay? And people selling you apples or selling you shoes or selling you whatever, that's a supplier. A supplier, or in general, that's a supply, okay? So in this example, I want to put it as demands means buys and supply means sells, okay? I'm putting it as this so that you can understand this example, all right? So what happens if more people want to buy than sell? So let's say you found a exquisite apple and you want to buy it, but you're not the only one. There's like 50 people behind you that want to buy the same apple, just one apple. There's only one apple available for 50 people. So what does this mean? There's only one supply, or there is a fixed supply, all right? And there is 50 people involved that wants to buy that one apple. My question to you is, what do you think it's going to happen to the price of that singular apple? The price is going to increase, okay? Because the demand goes up, and if the supply is low, the price goes up, okay? Now, let's think about this, but the other way around, okay? So I'm going to delete all of this. Let's say that you have 50 apples, guys. Let's just put it as an example. You have 50 apples as a supply, and there's only 5 people that want to buy apples. And you're getting desperate because there is no really demand for these apples you're selling. What's going to happen? The price, it's going to drop. The price is going to drop because there's more supply than demand. And this is the same thing with trading, guys, especially trading gold and these assets, like Bitcoin or cryptocurrency, even stocks, you have to understand the concept of supply and demand, because this is what trading is about. Now, let's talk about gold for a second. If there is a problem outside in the world, there is rumors of wars, there is a economic conflict, if there's something of that matter, then gold, it's going to go up. I don't know if you've noticed, but when Ukraine started, that thing with Russia, or Russia started that thing with Ukraine, what happened with gold? It shoot up. It shoot up from 2,800 all the way to 3,500 and more until, right now. So what am I trying to say? Whenever we see a problem with the world, gold goes up because there is a bigger demand. What happens? And why does this happen? Gold is a secure backed asset. So a lot of people feel secure if they have gold because the price is always going up, or it's always stable. So there is like a good feeling about it. So whenever there is a problem with the world, guess what? The demand goes up, and the supply available to buy, it's just not a lot. So that's why the prices of gold go up. Okay. So I just wanted to put that in perspective for you, and for you to understand how supply and demand works. Now let's talk about some other tools that we use in trading, guys, because trading is all about using the right tools, because if you don't have them, your trading experience could be a little different. All right. So the next thing I want to show you is, when does the market move? Because you're going to notice that there's just going to be certain times that the market is going to move faster than other times. And you can figure this out by understanding that the market moves by hours or by sessions. Okay. So there are 4 major sessions: Sydney, Tokyo, London, and New York. And these sessions are pretty much banks or institutions in those areas of the world. For example, the New York market opens at 8 a.m. Eastern time and it closes at 5 p.m. Eastern time. You want to guess why? Because that's when the banks are open in the USA. So the banks Eastern time in New York Stock Exchange opens at 8 a.m. and it closes at 5 p.m. when the last employee walks out of that door. And that's when the New York market opens. That's when we have the volume from New York market. Now, for London, guess what? London opens at 8 a.m. UK time and it closes at 5 p.m. UK time. And same with Tokyo and Sydney. And that's why we have these Forex market time zones, converter in this case. And this app is completely free, guys. This tool is completely free. You can find it in babypips.com/tools/forex-market-hour. And this is completely free. And you can move this. You don't have to touch anything because it already comes with the time that you're in right now. So right now for me, it's 1:09 p.m. Okay. It's about to finish the New York market. So Right now, if we move this around, we're going to understand that for me, that Sydney market opens at 3 p.m. 3 p.m. And the Tokyo market opens at 6 p.m. The London market opens at 1 a.m. and the New York market opens at 6 a.m. my time. All right. So this tool is really easy so that you can see and you can set up your times that you want to trade in, because there is a small little secret. The market moves whenever we have a new session open. What does that mean? Whenever it was 6 a.m., the market was moving really fast or really aggressive because there was more volume involved, because the New York market open. And not only that, but look at this, London was still open. So these two sessions correlate each other, which means there is going to be a lot of movement, a lot of volume. Okay. Same with Asia and Tokyo. Look at this. There is at one point that Tokyo and London, they go together. Look at this. Tokyo, opening of London, and you have like couple hours that they go together. And so there is a lot of movement in these sessions that correlate each other. And there is a lot of movement when a new session is open. Now you can also see over here in the bottom, if there is an estimate of when it's high, when it's low, and you can take this as a reference. Okay. Doesn't mean that it's going to be like that 100% of the time, but just take it as a reference. Now, last but not least, there's another thing you need to understand if you want to trade with volume or if you just want to trade normal. All right. The news, it's a big part of volume that's being moved within the market. So I'm going to show you something really quick over here. Since it's Friday, the market's going to close, but I'm going to just put it on Wednesday. Okay, let's put it on Thursday. All right. So if we look at this, guys, you need to understand a couple of things. You need to understand the color patterns that forexfactory.com is giving you. You have yellow, you have red, and you have orange. These three colors means something different. Yellow, it's not important. Orange, there's going to be some volume. Red, it's a high impact new, which means it's going to move. The market is going to react. All right. So you're going to see that folder next to the currency that the news is happening for. So for example, GBP. So anything related to the GBP, the pound, it's going to be a red folder for Thursday, for yesterday, and the market moved aggressively for GBPs around this time, just because of that news. Now, if we look at this New York market, all right, New York market, 6:30 a.m. for me, but that's the opening of New York. We already put these two together, right? It opens at 6 a.m. my time. So for New York, the US dollar was going to have a high impact news of unemployment claims, which means the US dollar, any pair related to US dollar, Euro USD, USD JPY, GBP USD, gold, right? XAU USD, any pair related to US dollar was going to have a high impact news, which means there is a high possibility that the market is going to shake and move really fast. Okay. And that's how you also know, how and when to trade. Because if you like these kind of movements, you can trade around these movements and there's nothing wrong with it. But just know that there will be a lot of movement. Okay. You can get spiked out. You can get moved. You can get your positions move as well. So if you are that type of person, you can trade around this. If not, you can just plan ahead. And this is why these tools are very important. Now you know what Forex is, how it moves, and when the game gets more serious. You don't need to memorize everything, just need to understand it, because that understanding is what's going to give you judgment. Let's move on into the next chapter. Now that you know how the market moves, I'm going to show you the basic tools you use to trade with clarity. One of the reasons many people don't start or fail in trading is because they feel overwhelmed by the tools. They don't know where to begin, to be honest, what to download, what each number means, or how to calculate the risk. But the truth is, you don't need 1,000 platforms. You just need to understand the ones that actually matter. In this chapter, we'll cover the basics: how to use TradingView, what is a pip, lot, and leverage, how to calculate the correct position size, how all of this looks when apply a MetaTrader on your phone. Plus, I'll show you the tools and calculators I personally use to simplify the process. The goal isn't for you to memorize it. The goal is for you to lose the fear. Let's break this down. So what is a pip? A pip is actually just a small price movement in the Forex market. Depending on the pair you're trading, there's going to be different ways to count pips or points of movement. All right. So I'm going to give you two examples. Euro USD. If Euro USD moves from 1.1000 to 1.1001, that is one pip of movement. All right. In gold, just to put you as a perspective of what we trade, if gold moves from 3,350 to 3,352, that is 10 pips of movement. So for every dollar gold moves equals 10 pips. All right. For every dollar that gold moves equals 10. And pips is just a way to count that movement, all right? What is a lot size? Because today I'm going to actually show you a calculator I use to calculate your lots and your risk, all right? So a lot is just the size of your trade. There are different types of lots like standard lots, mini lots, and micro lots, all right? One standard lot equals 100,000 units. 0.10 mini lots equals 10,000 units, and 0.01 micro lots equals 1,000 units. All right. So with one lot, each pip is worth around $10. With 0.10, each pip is worth $1. And with 0.01 lot, each pip is worth 10 cents. Okay. And now, last but not least, what is leverage? Leverage is just like borrowing money from your broker to trade a little bit bigger. For example, when you register in Tag, they ask you, what leverage you want to trade with. 150, 100, 500, and so on. So if you have $100 in your account and you selected a 100 leverage, you can trade with $10,000 per se. All right, because that's what leverage means. It lets you expand to trade bigger, but keep in mind that, it can help you, but it also increases your risk. Now let's go ahead and check the lot size calculator so that you can understand how to calculate your positions when you see a trade or when you want to enter a trade yourself. There is a lot of calculators out there. I honestly like this one. So you can, again, go to this website for free, pause the video, copy and paste this, and just use it for free. Now, I don't want to see all this, so I just click on this corner, and it's going to open me the whole calculator here. And what I'm going to do is I'm going to put the asset that I'm trading, in this case is gold, so XAU USD, and it's usually the first option, all right? And then US dollar, if your broker account is with dollars, or if it's with pounds, euros, this is up to you, okay? Open price, this is very important and easy. What price are you entering that trade? So for this example, let's just keep it simple, 98. Let's say you're entering for a sell and your stop loss is 34.08. That is a $10 difference, which means 100 pips. Because remember, every dollar in gold equals 10 pips. So 100 pips on this trade, your account balance is $10,000, 1, 2, 3. And let's say you're risking 1%, just for this example. So you put 1, you put percentage, and you click calculate. Now, I want you to pay close attention to this so you don't make this mistake. This is not your lot size. This is not your lot size. You see this over here? Click on this question mark and then click on calculate again. After you click that, this is your lot size for this trade in particular. Because remember, lot sizes are going to change depending on your stop loss and depending on your risk as well. If you're always trading with 100 pip stop loss in gold and always risking 1%, then this is going to be your lot size forever if you have that account. Okay. Now let's check out some numbers here. It's telling you money at risk is $100. So that's the max you're going to lose because you're risking 1% of $10,000, which is $100. All right. So you're risking 100 and this is your lot size. Now let's say my stop loss for a different trade is different. So I'm going to put a 30 pip stop loss, which means $3 of difference in gold. And I'm going to click calculate. Now you see that this number is different. Look at this. My risk in money is the same because it's the same $100 because it's 1%, but my lot size is 0.33. It's completely different. Why? Because my stop loss changed. My percentage didn't, so that's why my money is the same, but my stop loss did change. So that's why my lot size is different. And this is how you can easily, just calculate these numbers and you can put them in your MetaTrader as well, which I'm going to show you as an example in the phone. Okay. But as of right now, let's go and dive deep on TradingView as well, because I want to show you how to use TradingView really quick and really simple, really simplify it. So first things first, tradingview.com is free. You're going to see a lot of marketing promotions from them asking you to buy the product, upgrade. You're gonna see this table over here, and they have different options. If you want to buy, you can do a lot more things. You can put a lot of charts in your screen. You can put more alerts. You can get rid of the ads because there's some ads that come up here, and that's what happens when you have it free. Guys, I've been trading for so long. I don't pay TradingView. I paid it for my first year that I was trading just because my mentor wanted to get money off of that. And I thought it was a good idea because of the alerts and all this. But for me, guys, in my personal opinion, I don't buy TradingView. I don't have it right now. If you're going to see ads and you're going to see that I don't have the TradingView pay version because I don't really need it. If you feel like you need it when you're getting started, that is a really up to you decision. Okay. But just sign up, create a free account, go over here where it says products, super charts, and it's going to take you here. Now, the first thing you want to do, because when you have a brand new TradingView account, you're going to have a lot of pairs on this side and you're going to just delete them all. Delete them all. Doesn't matter. Just click this, delete, and then you're going to add the pairs that you're going to trade. And I'm going to move my camera and just of right now on this side, hello. But right here is where you can add it. Look at my mouse right now. You click this and then it's going to add you the symbols you want. So for example, if you're trading gold, XAU USD, Oanda, click this. All right. If you're trading Bitcoin, BTC USD, Coinbase, click this. All right. So don't add a lot of pairs just because. Just add the ones that you're going to trade. If you're trading with an educator, add the pairs that he trades. If you're trading on yourself, just add few pairs. Don't add them all. You don't need to add every single pair because that's not going to help you. You need to focus on one thing at a time and be consistent. All right. So I'm going to move my camera back and we're going to continue. Now, after you have the pairs added, the next thing is understanding where things are. So if you look at over here, these are called time frames. Each candle you see is represented by the time that you click. So I'm going to delete this so that you can see a little bit better. But for example, right now, this black candle you see over here, it's a 15-minute candle, which means that candle is going to last for 15 minutes. And you can see over here the remaining time, 13 minutes. All right, this candle is fresh, is new. If we change to 1 minute, each of these candles are 1 minute long. That's what represent. Okay, if we click 1 hour, again, each of these candles represent 1 hour. All right, so it depends on the strategy, depends on what you're looking for, depends on everything, but these are your time frames. Right here is where you can add indicators. I don't really use them. That's why I'm not going to teach you a lot about them. But yeah, they're there. Right here, you can create alerts. And then on the left side, it's where the magic happens per se. This is where you're going to have all the tools for free that you can use for your trading experience. So first things first, this right here is just a option for lines, pretty much for a trend line. Let's say you want to identify a trend line, you put this, boom, you have an uptrend. You have a trend that is going up. All right. Depending on the time frame you're looking, things are going to look a little different, right? If I were to put a trend line over here, this will be the right way to put it. And this will be an area for buying. Okay. Now, if I want to put a horizontal line, which I use a lot to identify support and resistance, as you can see over here, look at these blue lines. That's the horizontal lines that I put so that I know where my resistance and where my supports are. Okay. So you can use it as well. You can double click and you change the color of them. You can put tags. You can put exact numbers. You can change everything. Okay. Now, if you go down one more, you're going to find all the Fibonacci's. Fibonacci's are just a mathematical equation that it's there in the trading world. You don't have to use it if you don't want to, but you can learn about it. Okay. So if you want to draw a Fibonacci, you can definitely do it. And that's how you draw it. Okay. Now, eventually in the sessions, we're going to learn about it. I don't use it for my strategy, but it's good to learn about it. Okay. Now, the next thing right here is the harmonic patterns. You have this, you have the Elliott waves, you have cycles, you have a lot of free tools, guys, that you can use on your advantage. Now, the next thing I wanted to show you really quick that we do use a lot just for visual purposes. But if you click on this one, you see long and short. Right here, we can project a trade. Doesn't mean that you're taking a trade, you're just projecting it. So for long means buys and short means sells. So have you seen this before? I'm pretty sure you've seen videos on the internet that include something like this. So the red part means the stop loss area and the green part means the TP area, the take profit area. And so depending on the trade, depending on the situation you want to take, this is what you will put. And you will put it just for visual so that you can see how the trade went, while you took it. For example, here, I put this one as a visual of this buy over here that we took, just as a visual. Okay. And again, this is a great tool if you're that kind of person that you need to see things. I use this a lot. Okay. So that's for buys and short is for sells. All right. This will also tell you a little bit of risk reward. So if you notice over here, this means it's a 1 and 2. So you have a ratio of 2, which means you're risking 750 to make 1,500. That's a 1 and 2. Okay. You see over here, 740, which means points, or 7.2. And then right here, 15 points or 1,500. All right. So this is how you can also calculate your risk reward easily. All right. Now, last but not least, you have another tools for visual, which are brushes, arrows. For example, this, if I were to point you something, I would use this. If I were to draw something over here, it's like, hey guys, this area is very important. That's it. So I would use that for visual purposes, especially the rectangle that you see over here. Again, visual. It's just for you to help you see better. And you can also add text separately if you want to with this option here, emojis, and a lot more of the tools, guys. We don't need to go really, really in deep because, again, I want you guys to focus on one thing at a time. But I do want you to go and explore TradingView because all of these tools are for free. All these tools are for free and for you to use. All right, now we're going to do it here in the phone so that you can see how to actually put it in your MetaTrader. So let's go ahead and do another quick example here. We're going to do a 40 pip. All right, 40 pip means $4 of movement from 96 to 00. It's $4. Your account balance should be the same as you put in your MetaTrader from your broker. And in this case, it's $1,000. For this example, we're risking 1%. And don't forget that if you get a question mark here on the lots, you're going to click on it and you're going to click calculate again. Okay, so for this example, in this trade, I'm risking 1% of 1,000, which is $10. And my risk and lots is 0.025. All right. We're only going to put 2 because the extra number won't let us put it in. Okay. So now let's go to MetaTrader. And just so you know, if you never use MetaTrader, you can click here and add the pair. So we're going again, click here and XAU USD. You see that I already click on it. So if you put a check mark on it and click cancel, it's going to have it over here. Now you're going to click trade. And after you click trade, you're going to put the stop loss, which is 3,400 in this example. And you're going to put the TP, which is whatever the educator said or whatever your analysis said. So we're going to put the 0.02 risk, and we're going to click sell by market, which means sell now. And that's it. That's how you have that trade open. And if you go over here, you can see how the trade is open. You can click once and you're going to see that you're risking $7 to $8. In this case, the price already moved from where we started calculating it. So you're risking a little bit less. And your TP projection, you can also see it. You can move this. And after you move it, you can click this arrow over here and modify it if you want to and if you need to. If you want to close the trade, just come over here, click once and click close position and click this orange button and the trade will close by itself. All right. And that's how you put a trade, and that's how you manage it here in MetaTrader. Now you know the essential tools to trade without guessing. The difference between a beginner who loses and one who starts with clarity is that the second one has structure. And the structure begins by knowing what you're doing, with which tools, and how to calculate what you're risking. In the next chapter, we're going to cover something many people ignore: how a broker works and how to use it in your advantage. You can have the best strategy in the world, but if your money is in the wrong hands, it won't matter. Because this isn't just about knowing how to trade. It's also about knowing who you're trading with. To trade in the market, you need access to it, and that's where the broker comes in. This is the company that executes your trades when you're placing them. It's the bridge between you and the real market. Without a broker, there's no trading. But that doesn't mean that all brokers are the same. Choosing the wrong broker can cost you time, money, and a lot of frustration. That's why before I show you how to use one, I need to explain what you should look for when choosing one. First, it must be a regulated broker, one that complies with standards and is properly supervised. Second, it should have good execution. This means that when you click, your order is executed quickly and in the right price. Third, it shouldn't overcharge you with spreads or hidden fees. Fourth, it must have a reliable support in your language, because if one day you have an issue and nobody answers, you are on your own. And lastly, something few people talk about: it shouldn't limit you when you want to withdraw your money. If you're wondering, I currently use TagMarket because it meets all of this criteria. It's regulated, has fast execution, supports Spanish and English, and most importantly, I can trade with peace of mind and withdraw without hassle. In this lesson, I'll teach you how to create your account with Tag and connect it to MetaTrader 5. Of course, you're free to use any other broker if you already have one. But if you're just starting out, it's better to save yourself time, confusion, and potentially losing your money. All right, so the first thing that you need to do is go to tagmarkets.com. And once you're in the website, you're going to go ahead and click register. And this will take you to the register page, which only contains individual and company. This is really up to you. If you're a company, you're more than welcome to register as a company. If you're an individual, go ahead and do it so, okay? Let's fill our names, fill our information, put it, and I want to make this clear. Put this information as it shows in your ID, because you're going to need it when it's time to verify your account. So we're going to go ahead and create an account here really quick. Make sure you put your country. I want to put something clear right here. If you are from the USA, from the United States, you cannot register in Tag, okay? Whether you're from Colombia, Dubai, England, or wherever that is, except the US. just go ahead and find it. I'm going to just put Colombia as an example. Put your phone number in there and then click I have read and accepted the acknowledgement, the agreement. You can read them on your own time and pace. So now that you have registered, you're going to get an email with the password you got in. And in this email, all you got to do is click on verify email. We're going to show you that in a second. So once you're in your email, you're going to see this that says, hello, your name. Please click on the button below to validate your email. This is very important. You click on it, and after you do that, a new website is going to pop up, and you're going to see that it has been successfully validated, and it's going to take you to the portal of your new TagMarket's account. Now, the next thing you got to do is you got to verify that account. You got to do your KYC. As soon as you get in, you see this red message that says, please complete your KYC verification in order to make a deposit. That's what we want to do. We want to go ahead and click that. And all you got to do is upload your ID. Okay, you're going to click continue, upload your ID, and perform a liveness check. What does this mean? Just pretty much take a selfie within your phone or your computer. A really cool thing you can do if you don't like doing things in your computer, you can click this step over here, continue on phone, and it's going to give you a QR code you can scan. And after that, you're going to be able to do it from your phone. Okay? Super simple. Let's go ahead and get this verified. So now that you have your account fully verified, you're going to see this, and this is going to be your portal. Now, the first thing you want to do is you want to deposit, and you can do that by clicking on the left top corner, deposit USD, AUD, CAD, Euro, depending on your currency. Depending also on the amount you want to deposit, you can click these options or other and just input that information. And after you do that, it's going to tell you how. Depending on the country you're in, you can either do crypto, which is almost everywhere, if I'm not going to say everywhere, and then your car or bank account. And then if you're like South America, like Colombia, you can use other services like PSE and other bank services as well. Okay. So make sure you click the one that works for you. But if you want it to be like fast and reliable, I honestly suggest crypto, but it's really up to you. Okay. After you make your deposit, the next thing you want to do is you want to create your account. And you do this by going to this part right here where it says accounts. You're going to see real social trading demo, real demo social trading. Okay. Now, if you're a brand new person, and for the purposes of this video, we're going to create a demo account. Okay. Because if you're brand new, you should always start with the demo account to test yourself. But I'm going to give you a really good advice. Start the demo account with the money that you can project yourself deposited into the broker. You don't want to start your demo account with $1 million in demo or even $100,000 in demo, because at the end of the day, you're not going to put that money. Okay. If you have the $100,000 to deposit and that's what you're going to risk, then okay, go ahead and create it. But put something that you're going to actually deposit. So let's put an average of $1,000. Somebody's going to put $1,000. You have three options: pro demo, zero demo, and Islamic demo. For the purpose of this example, we're going to do pro demo, which is honestly the straightforward way. We have some commissions, some spread, okay, but it's not zero commissions, it's not zero spread. This is, for me, the best condition to trade with, but that's honestly your own preference. Now, the next thing, you're going to select your leverage. Again, average leverage is 100, okay, 1 to 100. You can learn more about this watching the community videos. So 1 to 100, make sure to put your password, which is the one that you created not too long ago. Okay. And then after you do that, you're going to click submit request. Once you submit your request for your account, you're going to see this message right in your screen, and you're also going to get an email with this information. But for the purposes of this video, let's get this information. So trading account, this is why you're going to need to log in and this password. You do not need the investor password. You only need this password, okay? So let's go ahead and log in into MetaTrader 5 from our phone. So once you're in MetaTrader 5, you're going to click here on settings and you're going to go where it says new account. You click new account and you're going to type Tag Markets. After you type Tag Markets, you're going to put the info that I just showed you before. The login, the trading account, and the password being the first password that it shows on that message or in your email. After you do this, make sure you click Save Password and sign in here at the bottom. And boom, just like that, you have your $1,000 demo that you just created with me a couple minutes ago or a couple seconds ago. This is what you're going to need to start trading. Right here, just a quick intro. You can look at all the pairs that you want to add. For example, we trade gold a lot, so we're going to go and add XAU USD, okay, by going over here, either typing it, okay, or you can also search it by going to Pro, Metals, and that's the pair, okay? You can also add any pair or delete or move anything that you put on this side of the screen. With this, you'll have your account set up and ready to enter the market. Next, we'll start covering the technical fundamentals, how to analyze price, what patterns to look for, and how to truly understand what the chart is telling you. The chart isn't there just to decorate your screen. It's there to actually tell you a story. And if you don't know how to read it, you'll get in and out of trades without any idea why you lost. In this chapter, I'm going to teach you the fundamentals of technical analysis, how to identify a support, a resistance, liquidity zones, how to understand price structure, whether it's trending or retracing, and how to draw your lines logically. You'll also learn how to protect your trade, what stop loss and take profit are, and how to calculate a risk-reward ratio that actually makes sense. No random entries, no moving your stop loss because you think the market is going to go up. This is technique and judgment from day one. Let's get right into it. And the first thing I want to show you is how to identify support and resistance and liquidity zones, okay? This is the very first concept that matters in trading. You're going to hear it a lot and maybe you're going to think it's something silly, but at the end of the day, everybody, institutions, banks, normal traders, bad traders, good traders, they know and they use support and resistance and liquidity zones. And so I'm going to show you right now on the screen just one example of a resistance, and then we're going to look for a support. This is the market live right now in XAU USD, which is gold, okay? So if we want to understand support and resistance, I'm going to illustrate it here really quick before getting into the charts. A support is your floor. So I want you right now, you're watching this video, maybe at home, maybe somewhere else on the street, at your job, doesn't matter. But wherever you are right now, I want you to think that a support is your floor. You're stepping, right now I'm stepping on my floor in my house. So a support is a floor. Okay, we're going to put it over here, floor. In the resistance, I want you to look up and then look at what you have above you, and you're going to see what? A ceiling, right? And so your resistance is your ceiling. And why do I want you to put this as an example? Because this is the easiest way for you to understand this simple concept. And so let me go ahead and delete this over here and just put this over here. I want you to imagine, close your eyes, grab a ball with your hand, or if you have one, just go grab a ball. Hopefully it's not a bowling ball because that will not end well. But just grab a soccer ball, basketball, volleyball, whatever you have, and throw it in the floor. And I want you to tell me if it bounces up. You grab it over here, you throw it in the floor, and if it bounces up, right? That's usually how it's supposed to happen, right? What happens if you throw it up to the ceiling? It's going to bounce down. Gravity, right? Gravity is taking place in gear. And so is in trading per se. So when we see the market hitting a specific area and you see it bouncing up
we know and we call that a support, okay? And when you see the market going up and then hitting a specific area and bouncing down, that's what we know and we call as a resistance. So this is the simplest way for you to remember what a support and resistance is. Pretty much bouncing areas where the market is, again, bouncing from either a down movement or an up movement. All right. And liquidity zones are pretty similar to this. This is super simple to identify. And with this, I'm going to go right into one example over here. So I want you to think right now, these two lines, what do you think they are? A support or a resistance? Just pause the video for 20 seconds if you want, if you need to see. But what do you see here? A support or a resistance? All right, so that is a resistance. So right here, why is it a resistance? Because the market is going up and then it bounced down. But it's not the first time that it bounces down. If you see over here, it bounced down over here. If you see over here, it bounced down over here. And again, over here, look at this. So all of this means that is a good resistance. It's a good area for the market to bounce down, right? We look for sells in this situation. Now, let me talk about liquidity zones before I move forward. So liquidity zones, and the simplest way to understand this right now is whenever you see a candle with a wicked rejection, that's what that's called. This line over here, it's called a wicked rejection. Whenever you see the market with lines above the candles, that is liquidity that was left off, or that's liquidity that was trying to catch previous liquidity. So if we look over here, we have a lot of liquidity here. We don't have a lot over here, but we were left with a lot of liquidity. What does that mean? It's going to fight its way either down or up. And in future concepts, I will teach you about something called a break and retest. All right. Not today, not right now, but in the future, I will tell you, these aren't just resistance. If they break up and they retest that breakout, then now it becomes a new support. All right. But that's it. I'm not going to tell you anything else. I just want you to focus on what we're saying right now. All right. So now we see a resistance and now we see a support. Look at this. Resistance, support. We talked about this literally 2 minutes ago, where I will show you the bouncing up and down. And this is a good example. The market came, it bounced down the resistance, it bounced up the support, it bounced down, and now it bounced up. So right now, this is called a consolidation, where you see the market hitting support and resistance back and forth, back and forth. All right. Now, how to tell if the market is trending or retracing and how to draw your lines logically. Let's go back here in the graphs. The market, the best way to know if it's trending, you got to know that there are two trends, the uptrend and the downtrend. And there is a third one, if we want to call it a trend, and that is the consolidation. All right. Consolidation means it stays within a range. An uptrend means it's going up. A downtrend or retracement, it means it's going down. All right. But how can you tell if the market is going up or down? Depending on the time frame you're looking for example, if you're trading with 15 minutes or 1 hour, things can change depending on the bigger or smaller picture you're looking at. Okay. So let's say we're trading with 15 minutes. I want to be able to focus on the last thing I can see from my screen. So if I can see all of this, I'm good. All right. And what can I tell from seeing all the way here to here? Well, first, the market first was in an uptrend. Why? Because look at this candle. It broke all the levels and then it went up consistently until we got to this point. So we had an uptrend until this point. Then the market broke down the structure and start creating a downtrend. So again, we look at this and we have a downtrend. Super simple. Now, if we want to focus on what we have right now, because, I can say the market is in a downtrend, because in the bigger picture, it's actually on a downtrend. But if you see this, the market broke through that trend. So we put the trend line over here, hitting all the resistance, and the market broke through that trend line, that downtrend, which means it could possibly be creating a new trend. Okay. So if we want to focus on the short term, we are going to say that this is actually kind of consolidating, right? We can say that from here to here, it's an uptrend. That's pretty obvious, right? But we can also say that from here to here, it was a downtrend. So for me, guys, the best way to put this is we're kind of consolidated. Because if you think about it, look at this. We're hitting this area, we're hitting this area. We're hitting highs, we're hitting lows. And so for me, we are kind of consolidated. Of course, we have a bullish or an uptrend momentum, but everything will be defined as soon as this area breaks up and continues into a new uptrend. Okay, we already know it broke through. It's just a matter of it's going to continue after it breaks this area. Okay. Now, how do you draw your lines logically? You want to be as comfortable as you feel, guys, because trading is really all about you. I can tell you this, but hey, you might feel comfortable with something else, and that's okay. But for me, I feel comfortable drawing the following way. I usually do this. So I usually draw at the wick of rejection. Look at this. And I usually draw, 1 second, there you go, at the last body that I see. And what do I mean by body? I'm going to scroll all the way until you can see this. But a body is pretty much the candle, right? So we know the wick of rejection is this long lines and the body is the candles. And so I want to draw 2 lines where the wicked and the body are set. So for me, this area right here, this is my support, all of this. And my resistance, I'm going to do the same thing. So I'm going to grab this, I'm going to put it here, and I'm going to put it here. My resistance area is a little bit bigger, but this is it. Okay. So this is how you draw a line, especially if you're brand new. You must follow this like exactly until you're in the point that you start, discovering things for yourself and liking things certain way. I'm not going to tell you that, but if you're brand new, you must do this. Okay. Now, how do you protect your trades? That is very important because stop loss and take profit are really what helps a trader, especially at the beginning and later on, to stay consistent and to stay disciplined. And so I'm going to show you, what a stop loss and take profit are, okay? And how to calculate a risk and reward that actually makes sense. And I'm going to show you this example right here, okay? This was a trade I took last night for the Asia session. And this trade was amazing, guys. Was completely amazing. But I'm going to show you what I did. I found a support. All right. As you can tell, this line over here, I found a support. And what I did was super simple. And I'm going to show you over here. I defined what I wanted to risk versus what I wanted to make. And so in this trade, I was willing to risk anywhere between 20 to 50 pips on the stop loss. We already talked about this, okay? I wanted to risk 20 to 50 pips. That means 2 to $5 of the price of gold. All right? Because remember, $1 equals 10 pips in gold. All right? $2 to $5 of risk. And I wanted to make at least 4 times my risk. And so with that being said, that would be 200 pips. All right? That's like the max. Because if I'm risking 50, 50 times 4 equals 200. If I'm risking 20, then that would be different. All right? That would be like 80 to 100. All right? 80 to 100 depending on the trades and depending on the pips. So the first thing I want to do is find what I want to do. If I don't know what I want to do, I shouldn't enter a trade. So after I find this, I start setting up the trade. And remember, we have free tools in TradingView. You go over here, you grab the long position and you put it here, and then you put the stop loss how you want it. All right. So the entry was 13. The stop loss was 10. So that was actually 30 pips what I risked yesterday. And if I want to make times 4, that will be 120 pips, right? And so I start counting 120 pips plus what we have right now, which is 13, it will be 25. So actually, it will be over here. So this is a 1-4. This is a trade where I risk 30 to make 120. Okay? Let's put it this way. 30 pips, risk, stop loss. TP, 120 tips. This is honestly the best thing I can tell you right now. Find good risk rewards. Because if you're risking 100 pips to make 20 pips, it is not worth it. It is really stressful. But if you're risking what you know you want to risk and you want to make what you want to make, then it makes a completely different experience for you in trading. So make sure that when you set your risk, you also set your profit. And this is how you calculate a risk and reward. And sometimes, or not sometimes, but you're going to see a lot of things like this. Oh, we just make a 1-1 risk reward. We just made a 1-2 risk reward. And I want you to know now that this is what it means. If you see a 1-4, 1-1, 1-2, 1-3, 1, whatever, RR means risk reward. And you already know that it means that we risk either 30 pips, 50 pips, or whatever the amount is, and we're making 1, twice, third, 4 times what we risk. Okay? And that's the beauty in trading. That's the beauty on knowing all of these concepts. And that's the beauty of putting a stop loss and a take profit, because you can tell better how to run these.
At this point, you're making huge progress. You're starting to understand charts and trading like a language that you can master. And that is what separates someone who trades with a plan from someone who just buys and sells blindly. In the next chapter, we're going to talk about something that makes all the difference: how to think before you trade. Because having a good entry means absolutely nothing if your mind isn't ready to sustain it. Many people lose money not because they trade poorly, but because they think poorly. The problem isn't just technical. It's actually mental. When you're starting out, it's normal to feel anxious, to want fast results, to jump in and out of the market like it's a video game. I get it. I've been there. But if you don't train your mind, you'll fall into the same old mistakes. Overtrading, moving your stop loss, getting frustrated, comparing yourself to others, and worse of all, quitting too soon. In this chapter, we're going to talk about that, the mindset you need, and how to avoid the most common beginner mistakes. Because if your mind isn't prepared, no strategy will actually save you. All right, now let's talk real. I'm going to be completely honest with you. This is a space between you and me right now. One of the most common mistakes that you can make as a beginner is thinking that the money that you have right there is going to be multiplied magically overnight. And so what happens with that? You start overthinking what you're going to do with money that you don't have yet. It's okay to have dreams. It's okay to have goals. For example, a lot of people want a new house. A lot of people want a new car. A lot of people want financial freedom. A lot of people want, I don't know, going to trips to Dubai, to Egypt, to Europe, wherever the place may be that you have as a goal. It's okay to have it. But here's where it comes real. You cannot make fake expectations with money you do not have right now. Because if you do, you're just going to be stressed. And trading and stress do not go together. Bad things can happen when those two combine. And so, why do I want to make this huge emphasis on this subject? Because it happens a lot more than you think. Let's say you start an account with $1,000 and you have the expectation that you're going to make $5,000 that month. That's where things start going wrong. When you create that expectation that it hasn't happened yet, if you've done it before multiple times, then the expectation can become real because you've done it before. But it's not there yet, especially if you're a brand new person. So please do not plan to use money that you don't have in your account right now. It's good to have goals, but don't make false or fake expectations before that happens. Now, another advice I want to give you is start with the demo account. If you've never done trading before, this is the first step that you must do. Because doing a demo account is going to help you pretty much like get used to what you're going to do in the real account. Now, let's stop over here and talk for a second. Demo accounts can be dangerous as well because people don't take it serious. And maybe it's a good thing if you see it that way at the end of the video. Now, people don't take demo accounts serious. That's why I mentioned in the previous video that if you're going to make a deposit, create a demo account as if you were to put that money in the demo. For example, if you only have $1,000 to invest, then create a $1,000 demo account. You cannot create a $50K, $100,000, $1 million because you're not going to trade with that money right away. You eventually get there, but not right now. So, people, a big mistake that I see in new traders is that they trade in the demo and they do amazing. They perform like they're millionaires. But then when they start the live account, they start hitting loss after loss after loss after loss, and they don't know why. It's because they're not taking it serious. It's because they didn't go through the demo process as well as they should. And also because they're thinking about all the stress behind and all that you need that money for. And we're going to circle back on what I already repeated a couple minutes ago. So, start with the demo. Treat it like it's your real capital because it's going to help you when you actually put your real capital into action. And just to finish things up, let's wrap up by talking about what happens when you go into a losing streak. They happen and it's okay. But here's what's not okay. Not take action and try to revise or review what's going on. So let's say you lost 2-3 trades in a row. That's okay. That happens. But if you lost 7, 8, 9, 10, 11 trades in a row, that's when you should start thinking about, okay, I need to stop before I burn my capital and I need to check what I'm doing. Am I following my trading plan? Am I risking what I say I was going to risk in every trade? Am I putting stop loss on my trades? These are just simple things that people miss when they start trading. And those 3 things are the most common factors that you need to have in your mind if you want to survive in the trading psychology. Now you know that the real work starts within you. It's not all about technique and that your mind needs to structure too. With this, we close the basic module. You now have the tools, the access, the knowledge, and most importantly, the mindset. In the next module, we're going to start building your strategy. You understand how to see the market clearly, how to execute with judgment, and how to make real, not emotional decisions. See you in the intermediate module.